when the switch is flipped. And that's why I like the term little by little by little by little, but then all at once, logarithmic decay. The little by little you can see. And I'll show you that here in 1 second, but you can see the little by little in all of these bilateral deals that are being struck and using the bridge and selling treasuries and buying gold. That's the little by little by little. And yes, the all at once, every country in the world has had to stockpile dollars for 50 years. It was 50 years last week that the deal was signed in order to buy oil. And if everyone had no incentive to ever hold those dollars again, the dumping of those dollars, this is the great reset I talk about, would create hyperinflation as that tsunami of dollars hit our shore, overwhelm the issuer, the US, creating hyperinflation. And the byproduct of hyperinflation is to see interest rates rise to compensate, not directed by the Fed or Powell, who doesn't want to do that and blow everything up. But if the market does it, we now have a villain to point to. Those guys dump the dollar. They're not taking the dollar for oil any longer. It's Xi Jinping and Putin and OPEC and Saudi Arabia. How could they do this to us? Well, forget about the fact that we signed an executive order to go green, or that our bonehead, knucklehead, embarrassing lead economic advisor, who embarrassed himself horribly in that video that circulated around Twitter for the last few weeks about him trying to explain money creation and bond sales. His whole theory is to lose the reserve status. And when we talk about the share of reserves, as of just a couple days ago, gold's share of global international reserves has jumped to 17.6% in 2023, the most in 27 years. The share has almost doubled since 2016 as central banks ramp up purchase. But here's the interesting part. Gold is now the second largest asset held in global central bank reserves, exceeding the euro for the first time ever. The number one is still the US dollar, but its 48% world share is down from 60%. Meanwhile, the central bank's net gold purchases saw a record in Q1 2024. They're selling dollars, they're selling euro, they're selling treasuries, and they are buying gold, which can't be sanctioned. And so, yeah, the all at once hasn't happened yet. But how hard would it be for OPEC to say we're done taking dollars for oil? That's the rumor that's been circulating around the internet, that the petrodollar deal wasn't renewed. Now, I would be the first one to scream that from the rooftops. But I haven't seen any official acknowledgement of that yet. So I'm not going to run with it other than to say a lot of people are saying it's already happened. I don't know if I can believe that or not. I never saw a 50-year timeline on the original agreement, nor have I seen any official statements from Saudi Arabia or the US. But I'll tell you one thing. We did see the United Arab Emirates say we don't want to take dollars anymore. And they're the seventh largest producer of oil in the world and an OPEC member, and we're admitted into BRICS alongside Saudi Arabia. So to imagine an environment where the world dumps dollars because they're no longer needed for oil purchases, as every OPEC country is on the Belt Road, and all of these countries are moving away from this country because of sanctions and because of our behavior and because we're going green. So what do they need to work with us for? A currency where we've obviously chosen inflation over austerity, and a bond market that's been volatile as hell. And if indeed we did see that moment, and Rafi is right, the all at once moment where dollars are forsaken because you don't need them for oil anymore. And to his point, every country in the world's had to stockpile them for 50 years. Yeah, the ramifications or the result would be disastrous, because you would see interest rates spike to compensate for that hyperinflation, and all of the assets in this country, stocks, bonds, real estate, and even the banks, which are over leveraged and undercapitalized, and the insurance companies are loaded with treasuries, they're all inversely related or correlated or valued to a massive spike in interest rates. So yeah, it would be disastrous, and it would happen very quickly.
Andy Schectman continues his exploration of the evolving global financial landscape by discussing the potential implications of these shifts on the U.S. economy and the broader geopolitical order. He emphasizes that the gradual move away from the dollar is part of a larger strategy by various nations to protect themselves from the volatility and geopolitical risks associated with the U.S. financial system. Schectman highlights the role of the Belt and Road Initiative, BRI, in facilitating this transition. The BRI, led by China, aims to create a vast network of trade routes connecting Asia, Europe, and Africa. Many OPEC countries are part of this initiative, which encourages trade in local currencies and commodities like gold and oil, further reducing dependence on the US dollar. This strategic alignment is accelerating the shift towards a multipolar financial system where the dollar's dominance is increasingly challenged. The potential for a sudden and dramatic shift, or the all-at-once moment, If countries no longer need to hold dollars for oil transactions and begin dumping their dollar reserves, it could trigger hyperinflation in the US. The subsequent spike in interest rates would have severe repercussions for all asset classes, including stocks, bonds, real estate, and the banking sector. The interconnected nature of these markets means that a significant disruption in one area could cascade across the entire financial system. Schectman underscores the importance of understanding these dynamics and preparing for potential volatility. He advises that gold, as a stable and tangible asset, offers a hedge against the uncertainties of the fiat currency system. Unlike digital currencies or fiat money, gold is not subject to the same risks of devaluation or sanctions, making it a reliable store of value in times of economic uncertainty. He also discusses the strategic moves by central banks to diversify their reserves away from the dollar. Central banks are increasingly turning to gold, as evidenced by the record net gold purchases in Q1 2024. This shift is not just a response to economic factors, but also a strategic move to insulate their economies from the geopolitical risks associated with the US dollar. As central banks continue to buy gold, its share of global reserves is likely to increase, further reinforcing its role as a key asset in the global financial system. The rise of digital currencies and new payment systems is another critical factor in this transition. Schectman explains that initiatives like mBridge are enabling countries to conduct cross-border transactions in their local digital currencies, bypassing traditional financial systems like SWIFT. This development reduces the influence of the US dollar in international trade and strengthens the position of commodities like gold and oil as primary assets for global transactions. The implications of these changes are profound. A move away from the dollar would reshape the global financial system, reducing the US's ability to impose economic sanctions and influence global markets. It would also lead to significant adjustments in exchange rates, interest rates, and asset values, affecting everything from consumer prices to international trade balances. Schectman emphasizes the need for individuals and investors to understand these trends and position themselves accordingly. The increasing volatility in financial markets and the potential for sudden shifts underscore the importance of holding stable and tangible assets like gold. By diversifying their portfolios and reducing their reliance on fiat currencies, individuals can protect their wealth from the uncertainties of the global financial system. In conclusion, Andy Schectman provides a comprehensive analysis of the gradual but significant shifts in global finance and their potential impact on the US economy and beyond. The strategic moves by nations to reduce their reliance on the dollar, increase their gold reserves, and adopt new digital payment systems are setting the stage for a major financial transformation. As these changes unfold, the value of gold as a stable and reliable store of wealth becomes increasingly clear. Schectman's insights highlight the importance of understanding these dynamics and preparing for the potential volatility and opportunities that lie ahead.
About mBridge maybe 2 years ago when it first came out, a year and a half, 2 years ago, and it's a coalition or collaboration, I should say, between the central banks of China, Hong Kong, Thailand, and the UAE. And I find it interesting, first and foremost, that what it is, it's a cross-border digital payment system that allows these countries to trade their local digital currencies with one another outside of the SWIFT system. So there's no SWIFT interference. And the first two test trades were done at the end of last year, 2023. The first one was using yuan, and I think it was with the UAE, digital yuan to buy oil. It was a cross-border oil purchase. The second one was a cross-border gold purchase. Now, if you ask me, commodities like gold and oil have been remonetized across the globe. They have become more valuable than the currencies that are purchasing them. This is Zoltan Pozsar's Bretton Woods 3, where commodities rule the day. And I find it interesting that that is the case. Now, I thought it was a big deal when it came out, and I talked a lot about it when it first came out, because this is a way for them to sidestep the sanctions. The sanctions are largely SWIFT related, right? So there was an article that just came out last week, June 5th. Saudi Arabia has joined a China-dominated central bank digital currency cross-border trial in what would be another step towards less of the world's oil trade being done in US dollars. The move announced by the BIS on Wednesday will see Saudi Arabia's central bank become a full participation of Project M-Bridge, a full participant of Project M-Bridge. And so, look, they decided to not go to the G7 meeting. They're now a full participant in the Project M-Bridge. We already know about the BRICS. We know about the Shanghai Cooperation Organization. All of the OPEC countries are on the Belt Road. You can see this stuff is starting to take shape. And I thought James Rickards had a very interesting take recently on why they haven't issued their common settlement currency. And I have to agree with it. And intuitively, this is what we've really said for a long time. But the way he explained it, I think, is worth just noting here. And that he said, look, there's 10 countries now, the 5 original plus Saudi Arabia, Iran, Egypt, Ethiopia, and Egypt. And so if they had a common settlement currency, even if it were pegged to gold or whatever, selling or buying from one of the 10 members with the common settlement currency, with the proceeds, you would want to use it to buy something. So you only have 9 other countries to shop with. Well, there was just a meeting that happened, as we've talked about on this show ad nauseum. There were going to be 200 meetings between the beginning of the year and the big BRICS meeting in October. And they just came out with a report here of a meeting that happened it's called NIZHNY, Nizhny Novgorod. And there was a meeting that just came out, and there were 54-point summation article that I read. And I'm just going to highlight a couple of them here. One is that this was just a couple days ago. 21,000 people attended from 139 nations. 78,000 in bilateral deals were signed on the sidelines, meaning I'm going to trade with my local currency and your local currency. We won't use the dollar. And most of these deals are now not putting their reserves, the excess, into treasuries. They're putting them into gold. But the third one is the big one, and that is 59 nations plan to join BRICS. This just came out of this meeting the other day. And so if you have 59 countries to trade with in common settlement, you can go shopping in 59 countries instead of 10. When they get this critical mass, a large enough group of countries that are now approaching, you add 59 countries on here, you bring in the Shanghai Cooperation and the Eurasian Economic Union, which you keep hearing about, it will happen. And then look at the Belt Road Initiative, you're talking 90% of human population. And so when you have more and more and more countries signing on to the BRICS, 59 countries have planned to join, you have the ability to issue a common settlement currency. It doesn't have to be a reserve currency. That's where gold can come in.
Andy Schectman concludes his analysis by delving into the broader implications of the ongoing shifts in global finance, particularly focusing on the strategic movements away from the US dollar and towards gold and alternative payment systems. He underscores that these changes are not merely economic adjustments, but represent a fundamental reordering of the global financial landscape, driven by a combination of geopolitical strategy and economic necessity. Schectman reiterates the significance of the little-by-little changes that are gradually eroding the dollar's dominance. These include bilateral trade agreements, the adoption of digital currencies, and the strategic accumulation of gold by central banks. He points out that these incremental changes are setting the stage for a sudden and dramatic shift, the all-at-once moment, where the dollar's role as the world's reserve currency could be significantly diminished. The potential for this shift is rooted in the historical context of the petrodollar system, established 50 years ago, which has required countries to hold dollars to buy oil. This system has created a massive global demand for dollars, underpinning its status as the dominant reserve currency. However, recent moves by major oil producers, such as the United Arab Emirates and potentially Saudi Arabia, to stop accepting dollars for oil signal a fundamental change. If these countries fully abandon the dollar, it would trigger a cascade of dollar sell-offs, leading to hyperinflation and a spike in interest rates as markets react to the flood of returning dollars. Schectman highlights the geopolitical context of these shifts, particularly the strategic moves by China and Russia to reduce their dependence on the dollar. These countries are not only selling off their dollar reserves, but also increasing their holdings of gold, which cannot be sanctioned or devalued by geopolitical conflicts. This strategic accumulation of gold is reflected in the increased share of gold in global central bank reserves, now the second largest asset held, surpassing the euro for the first time. The introduction of digital currencies and payment systems like bridge plays a crucial role in this transition. These systems allow countries to conduct transactions in their local currencies, bypassing the traditional SWIFT system and avoiding U.S. sanctions. The bridge initiative, involving central banks from China, Hong Kong, Thailand, and the UAE, is particularly significant. It demonstrates a concerted effort to create a parallel financial system that reduces the influence of the US dollar in global trade. Schectman also discusses the broader economic implications of these changes, including the potential for increased market volatility and disruptions in traditional asset values. A sudden shift away from the dollar would impact all major asset classes, from stocks and bonds to real estate and banking. The interconnected nature of these markets means that a disruption in one area could quickly spread, leading to a broader financial crisis. To mitigate these risks, Schectman advises individuals and investors to focus on tangible assets like gold. Unlike fiat currencies and digital assets, gold offers a stable store of value that is not subject to the same risks of devaluation or sanctions. By holding gold, investors can protect their wealth from the uncertainties and potential disruptions in the global financial system. He emphasizes that the current economic environment, characterized by high debt levels, ongoing monetary easing, and geopolitical tensions, creates a favorable backdrop for gold. These factors make precious metals an attractive investment for those looking to preserve wealth and hedge against economic uncertainty. The strategic moves by central banks to increase their gold reserves further underscore its importance as a key asset in the global financial system. Schectman also highlights the importance of understanding the broader geopolitical context and the strategic motivations behind these shifts. The moves by countries like China and Russia are not just economic decisions, but part of a broader strategy to reduce their vulnerability to U.S. economic and geopolitical power. By diversifying their reserves and adopting alternative payment systems, these countries are positioning themselves to be less reliant on the dollar and more resilient in the face of global economic shifts. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.